take our little trip back in time. So the history of the Federal Reserve Bank began really back when we had the new nation after the Revolutionary War. So following the war, we had this new nation, and we found ourselves in the position of where we needed some sort of national financial system to sort of operate and make the new government work. So you might imagine different people had different perspectives. So first we had Hamilton. Hamilton's proposal was more of a centralized type bank. He wanted a national bank that could issue money, that could store public funds, government funds, not public citizens that bank it. Banks like Bank of America or some of the other banks. This would be more of the public funds that were through taxation and things like that. It would support transactions, payments, if you will, payments to other governments, payments to businesses and things like that. And then, it would also act as the government's fiscal agent for when the government needed to make large transactions of a financial nature. For example, if the government was going to buy some new ships for the new army, those kind of things. So this was Hamilton. His proposal was more of a centralized proposal. Now Hamilton didn't have the last word or the only word. We had Jefferson at the time. And Jefferson, very much a states' rights, people's rights kind of guy. So Jefferson thought that, a national bank, a centralized bank, really would be unconstitutional because it would be an overreaching or an unauthorized exercise of federal powers to create this central bank. And then there was the other part where he was concerned that a bank of that power could be unduly influenced by powerful merchants or business people, and the population would be at the expense and mercy of those individuals that could influence such a bank. So you've got them on both extremes, and you probably haven't heard any of that with the elections going on now about small government, big government. Yeah, that's not, so I guess the takeaway is, hey, it's happened before. These guys aren't saying new things that haven't been said before. So, here we go. We had a bank that was established. It turns out that Hamilton won. He won the argument, convinced enough people, and they authorized what was called the Bank of the United States, or as I affectionately call it, the bus. So that's what they had. It first opened 1791. It was the first one. Now what was interesting about it was only given a 20-year charter. And that was probably a compromise that was made by those that were in favor of the bank in order to get the votes of the people that weren't so in favor of it. Maybe some that were sympathetic to Jefferson's point of view. So you know how Congress and legislative works. It's a give and take. You got to give something to get something, and they gave it a 20-year charter to try to get some of the votes. So that's how it came to be. And guess what? So at the end of the 20 years, the charter wasn't renewed. So it came up for renewal, and it did not get renewed. Apparently Congress, when the other things happens in 20 years, there's a little word called elections. So in elections, as people turned over, it could be that the sentiment within the Congress changed such that the new people that came in weren't as much in favor of a central bank. So maybe Jefferson got the last laugh here. But in any event, the bank was closed mainly because, not because it failed, it wasn't a financial failure, it simply did not get its charter renewed. So the next historical event that came about, so we had the War of 1812. Wars are expensive. It cost a lot of money to feed troops, to buy guns, and to buy horses back in that day, and run the war machine. Also, because of the great expense and the massive debt that was being undertaken, you had a big devaluation of the financial currency that was in place at the time. So the Revolutionary War continued for about 2.5 years. It was 1812 to about 1850, maybe it was close to 3. But at the end of the war, we were very heavily in debt as a nation, and we had a currency that was very devalued. And without a national bank, without some sort of centralized bank, the government found itself in a little bit of a straits in trying to figure out how to solve this problem. They didn't have a bank that could institute monetary policy that would have addressed the devaluation of the money, and they didn't have a bank that would allow the government to borrow funds that it could use to finance things and then pay that money back. So it was kind of a catch-22. So then we have Madison. So when you think of Madison, James Madison, he's Hamilton. He and Hamilton saw things very similarly. They were more centralized government. Wanted a national bank. He was very much in favor of promoting a safe and a stable currency instead of a currency that goes up and down in its value vis-a-vis other currencies. And then he thought it would handle the more bigger fiscal transactions. So if it sounds a lot like Hamilton, you're probably right. It's a lot like Hamilton. But Madison had his detractors. Not Jefferson, nope, the other J, Jackson. So the J's were against the central bank. And Jackson had a very, I tell you, this guy did not mince words when he expressed himself. Identified for some thieves, man. He's going to rout you out. So I think it's safe to say that Jackson was very adamantly opposed to the central bank. So he was very skeptical. And interestingly, for the same reasons that Jefferson was. He was opposed to the power and the concentration of the power and the potential for the power to be misused against the populace. Well, Jefferson and Jackson, they both lost the argument, as it turns out. So once again, after a lot of debate, a lot of fighting and arguing and giving and taking, we had another bank, Bust II, Bank of the United States II. So they chartered another one. Again, probably as a concession to get votes, they gave it a 20-year charter. So we had another bank. Great. We're moving forward. Look at this. We got closed again. Once again, charter expired, was not renewed. It was not a financial failure. The bank did not fail as some of the banks have since 2008, I'm sure. So is anybody in here aware that banks fail? Yeah. Georgia should be really aware that banks fail, given the number that failed in this state. So, but the bank did not fail because of money reasons. It wasn't a liquidity issue. It wasn't a capital issue. It simply was the fact that, hey, people did not want to reauthorize the charter. So that's, and they could not override the veto that Jackson put. So you remember back here on a previous slide, so Jackson was heavily against a central bank. Well, guess who got president? Jackson. And when the charter came up, Jackson vetoed it, and there was not enough votes in Congress to override the veto, so Jackson got the last laugh in this case. All right. So it's an old argument. Again, you hear it a lot today even. I don't think it's phrased as much in central versus decentralized government, but I think what you hear is you might hear states' rights versus federal, state versus federal government, and you might hear big government versus small government. So, but it's kind of it's the same arguments. So then what happened? Wow. So from a period of 1873 to 1907, we had some really tumultuous financial times. We had bank runs that were taking place. Does anybody, you guys know what a bank run is? And this means yes, and this means no. So, okay. So bank runs, we had panics, we had tons of bank failures during this time. The populace was very untrusting of banks. There wasn't a very centralized system to oversee the banks. They were very individually operated because people who chose a bank, it was hard to figure out, well, how do I choose a bank and know that the bank's safe? We didn't have FDIC insurance at the time, so your deposits, they weren't insured. It's a very difficult time. So here's the slide that shows you the closures. As you can see, they spiked in 1893, which you could change 1893 to like 2009 and probably look about the same. I think, we've had some parallels. The other thing that happened during this time was interest rates. Interest rates were as volatile and I'm going to try to pick something I think you might agree, the stock market. So interest rates range from anywhere from 2% to 125%. I mean, they're all over the board. Well, it's very difficult for people to financially plan and do business and carry out their lives daily with borrowings for homes or cars or whatever, horses. You know, when your interest rates are going from 2 to 125%. So it was a very bad time of volatility, disruption in the market, economy, a bad economic impact. So what happened? Then came the Federal Reserve. So the Federal Reserve Act is the act that authorized and created the Federal Reserve, the Federal Reserve System. It was passed in 1913, which, if you do the math, that means 2 years ago, a little over 2 years ago, the Fed celebrated its 100th anniversary. So Congress, at this point, had decided, you know what, the volatility is just too much. And so finally, there was a larger consensus that said, we really do need a central bank. We need a central financial institution that we can vest with the mandate of dealing with the economy, promoting a stable economy, and fighting inflation, so and full employment. So those are the things that they wanted to create with the act. So here we have a slide about why. So I mentioned the economic part, but then they also wanted to have a bank to promote some financial stability. As I mentioned a minute ago, during that time you had rates going up and down, you had businesses, banks failing, very difficult, very volatile. So the question then becomes, all right, so we've decided we want a central bank. How do we structure the thing? Because you still had people that were saying, wait a minute, too much power. That's a lot of power to put in one place. Then you had other people that were saying, wait a minute, if you put one bank, how are we in Colorado going to deal if the bank is in Atlanta? I mean, Atlanta's going to take care of Atlanta. What's going to happen to Colorado and its people? So they came up with a decentralized system where they chartered 12 Federal Reserve banks. And those banks were placed at the time, now in 1913, they were placed in strategic locations based on the sort of population and then the business centers at the time. Now that's one of the interesting things about the Federal Reserve System is this structure has remained unchanged for the 100 years, 102 years now, 3 almost. There have been some arguments, you may have heard them, that the Federal Reserve Act needs to be amended so that they can balance this more because, as you can tell from the slide, it's very heavily East Coast oriented. Middle of the country over. San Francisco Reserve Bank, wow, covers a lot of territory out there. So there have been some that have said this layout, this structure needs to be redone. I don't get involved in that. That's about 5, 10, 15K grades above me. That's the thinkers that think that stuff up. So the second thing we wanted, that was the politicians wanted, was they wanted some independence. So you know how it is when government has influence over things, is that they can influence things in a way that serves their agendas, maybe their constituents, and when you're elected, you have the constituents, then there's this thing called PACs and contributions and, for re-election and things like that. So what they wanted to do is to insulate the Federal Reserve from the politics that existed. So it had to be independent from the government. But it would be overseen. And that's why, in case you have seen, Yellen testifies before the Congress. That's part of the government oversight. There is, in the way the Federal Reserve System is structured, so you have the 12 banks, but above the 12 banks, you have something called the Federal Reserve Board. So the board is government. The board, under the governors, oversees all 12 banks. They set policy, they set standards, and they come in and look at the banks to see that they're complying with the standards and the policies. They call these things operations reviews. So the board oversees the 12 banks. How many of you think that the 12 reserve banks are government? They're not. They're private banks. They're not government banks. They're quasi, I mean, I guess you could argue they're quasi-governmental because they're overseen, but the Federal Reserve banks themselves, like the one that I work at in Atlanta, is not a government institution. So, all right, so why is independence important? Well, here's a little chart that shows you what happens with inflation. So they measured inflation on the left scale going vertical from 55 to 88. And then the bottom scale is a rating they give for central bank independence. And what the correlation is, the more independent the bank is from political, the lower the inflation rate is. So you see New Zealand and Spain in the top left corner, they're not very independent, politically speaking, from the governments that exist in those countries. According to this chart, correspondingly, inflation runs a great deal higher there than it does if you look over at the far lower right where the United States, Switzerland, and Germany are. So independence was important because the correlation is that if you don't have a lot of independence, you might have a lot higher inflation, which means prices are going up, and that's not good for your dollars. Your dollar's going to buy a lot less the more inflation you have. So it was very important to have the independence. So we've done our little trip in history, how we got here. So let's talk about what the Fed does in the modern era. What do we do today? So part of the Fed's approach nowadays is very inclusive. There's accountability and transparency. Those are three things that are high focus for the Fed. It's overseen by Congress. The Fed's also overseen at the bank level by the board. I mentioned that. And we are still independent and insulated from the short-term political interest. So those are kind of important things in terms of you don't want to undue influence by politicians, because the politicians may not have the same agenda. So the inclusion part, let me talk about that. The way inclusive is done, there's a committee at the Fed called RAIN, R-E-I-N, stands for Regional Economic Information Network. And what it is, the Fed does a lot of outreach, it does a lot of inclusion. So RAIN has about 3 or 4 committees. I can't name them all, but one's agriculture. There is an energy one, a committee. There is, I think it's transportation. And each one of these committees has about 14 members. They are business leaders, people who, like in the farm one, for example, there are people who own these big, huge farms, you know, those commercial farms that farm huge amounts of produce and things like that. So they use that as an inclusion to be able to get these business leaders in and these get economic information, because they feed back into the Fed what's going on in the particular reserve bank district that they're located in. So in Atlanta, and I'll show you a slide in a little bit about, we have Florida, Georgia, Alabama, and then we have portions of Tennessee, Louisiana, and Mississippi. So that's the Fed district for Atlanta. So those committees are made up of all these professionals and business leaders and corporate leaders in those particular groups. And that information it's to include these people in the Fed to get information so that you can't make a very decent decision. So the accountability, where we get that is there's lots of testimony. I think that's a picture of Yellen. She looks like she doesn't like the question or something, but there's a lot of testimony that goes on before Congress, constant. Testimony before committees, House Banking Committee, the Senate Banking Committee. These committees constantly call the board people at the Federal Reserve Board to the committees to give testimony. So there's anywhere from, I think, 3 to 5 people that I know of that have spoken the last 6 months. And then as far as accountability, transparency. So the Fed has a ton of information on its website about the operations of the Fed. They have policy statements they put out, there's news releases, balance sheets. The Fed's balance sheet is not secret. You can get that information on the Fed's website. So the Fed has some transparency in terms of the assets it owns, the balance sheet that it has, the earnings that it has. It makes announcements about how much money that the Fed earns, which, by the way, all earnings after costs are covered are turned over to the Treasury. So the Fed doesn't make a profit. It just turns its profit over to the U.S. government. So what's our job? Well, the Fed does three really important things. It does a lot of other things, but there's three really important ones. One, the Fed supervises banks. And when you think of banks, think also of bank holding companies. So the Federal Reserve is the single sole regulator for bank holding companies. No other regulator regulates bank holding companies. Now, with banks, the Fed regulates what's called state member banks. So what those are is it's a state chartered bank that says, I want to be a member of the Federal Reserve. And they buy some stock and they join the Fed and become a member. And they have to buy the stock because the way the law is structured, you can't be a member if you don't buy and subscribe to a certain amount of the stock of the Federal Reserve banks. That's just the way it works. So you have the state member banks we regulate. What we don't regulate and what other regulators do is state non-member banks. So state non-member banks are regulated by the FDIC and the states. National banks and savings and loan associations, like IndyMac used to be, or the one in that It's a Wonderful Life. That was about a savings and loan association, that movie. Those are regulated by the comptroller, the OCC, the Office of the Comptroller of the Currency. So you have a number of different regulators, but only one regulates the holding companies, and then we do this state member banks. So the payment system. Does everybody know what we mean by the payment system? All right, any of you have credit cards? What about debit cards, ATM cards? Checks. Do anybody still use checks? Okay, good. That's payments. So when we say payment system, we're talking about ACH transactions. We're talking about wire transfers. We are talking about checks, which the Fed still clears checks. We have checks that come through our system. And all checks are cleared in Atlanta, not in every other reserve bank. All of them are in Atlanta. So that's the payment system. And then we have the last part, and this is the part that most people are very familiar with, is the monetary policy part. That's the Federal Open Market Committee when they meet and decide, which I've gotten the question I think 5 times, is the interest rates. Where are they going? What are they going to do with them? They're going to raise them. That's the Federal Open Market Committee. So that's the monetary policy piece. And so it's not just interest rates, though. The monetary policy also includes discount rates. What that rate is it's the rate that applies to advances at the Federal Reserve discount windows. So the Federal Reserve loans money to banks. We are a bank to the banks. We do not have customers like John and Carol Smith or me. I couldn't open an account at the Fed. They don't deal with people like me. They deal with banks and large type financial institutions. So that's their customers. And they raise or lower the rate for the discount window, which, as you can imagine, if the rate's higher, banks don't borrow as much. They don't want to pay the high interest. And when the rates are low, it's more what they call an accommodating policy. So then the banks will borrow more money, and theoretically it spurs industry growth and job creation. So the Federal Reserve Bank's the lender of last resort. So when banks can't borrow from each other, they can't raise capital, they come to the Fed and they can get loans. The Fed also works to maximize employment. And you've seen a lot about this. Right now the employment rate's about 4.9%, the unemployment rate's about 4.9%. But I think you might have remembered during the crisis it went up to double digits. So it was really, really high. And then the other thing is to keep inflation at a sustainable low rate where it doesn't adversely impact the economy. And the Fed's current target rate, you'll see this in the publications, is about 2%. They think that's a healthy, not too high inflation rate. So this was the supervision and regulation part. We talked a little bit about the banks. The Federal Reserve Board writes the regulations. They make up the capital rules. Banks have to have this much capital. They make up the rules on lending. What do you have to do to make loans? And what do you need to do operational-wise? All of the requirements are set at the board level. The board delegates to the 12 reserve banks what's called the examination function. So the Federal Reserve banks operate as the arm of the Federal Reserve Board, and we have a team of examiners, an entire division of examiners, and their job is to go out and do reviews. And so here's a funny term of art. So for banks, we call it examination. For holding companies, we call them inspections. They're the same thing. We look at their books and records and determine whether they're complying with the laws and the regs. So that function's been delegated to the reserve banks, overseen by the board. Payment services. So what's intended to happen there is to support the integrity, efficiency, and accessibility of the payments and the settlement systems. There are many types of payments that go, even international payments. The Fed clears international checks. An international check would be where a citizen of another country is perhaps in the U.S. on a visa. They've got a check drawn, Canadian banks. You know, they probably have writing a check that's drawn on TD Bank in Canada or Royal Bank of Canada or somebody like that. Well, those checks written in the U.S. have to go to the Fed. And then we clear them, send them to Canada, and then they get paid, and then the money goes back through the system to the depositor. So that's the settlement system. And then we also handle ACH transactions, the cards. We do cash. We have cash services. Take cash to banks when they need the cash, do cash runs. Those are the kind of things. But it has to be very stable, because if the system's very volatile, it could interrupt the payment system, and then you'll have situations where commerce can't take place. If payments can't be made and it's not very stable, you're going to have a disruption in the market. We talked about a banker's bank. Okay, so this is important. So there's two types of payments. There's what we call retail payments. That's us in the room, right? You go to Walmart, you go to Target, or Target as my wife calls it, and you buy something. So that's a retail payment. Wholesale payments, think of big, huge payments, very large payments, corporate payments, payments like payroll payments for big companies, those kind of things. Banks sometimes make huge payments to purchase enormous assets. Well, those are the wholesale payments. So the last one is monetary policy. And again, the monetary policy, the directive is to set the policy in order to attain maximum employment, which is not 100%. It's not 100%. It depends. Maximum employment really depends on what the economic situation is. Although there are target rates. And then you have price stability, which is the inflation piece. Because if your inflation is running rampant, you're going to have really volatile and high prices. So what do you think, I'm sure you've all heard that inflation is kind of, we don't have an inflation problem at the moment. So what one commodity do you think has gone down so much that has affected inflation recently? Oil. It has I heard the other day it was $29, $28 a barrel, which is down from like 150. So it has really depressed the inflation rate. That doesn't mean other things haven't gone up. All right, so the difference between fiscal policy, monetary policy, the board does not do fiscal policy. That's a legislative federal government approach to borrowing, spending, and taxation. What the Fed does is manage money supplies and interest rates. It sets that in order to influence credit availability. Goals are different for the fiscal policy. It's to fund operations, to manage growth. The Fed, its goals are simply price stability and maximum sustainable employment. And then who's responsible? You got executive and legislative that deals with fiscal policies, and the Federal Reserve is the only entity that deals with monetary policy. And then the tools they have are at the bottom. You can see the Fed has a lot of tools. I'm not going to go through them all because there's different ones, but the Fed can buy and sell securities. I think John and I were talking, he was mentioning the Fed's balance sheet and the fact that they had bought assets during the crisis to stabilize the economy and the banks. They can lend money to banks, they can pay interest on bank reserves, which is like if you had a deposit account at a bank and you earned interest on it. Banks have deposits with the Fed, and the Fed has the ability to pay them interest. All right, so now we're going to move into economic outlook. I don't have a clock, so I don't know if I'm on time or off time.
We're out of time.
I'm sorry.
Yeah, we're out of time.
I didn't see how much time I had.
Yeah.
Sorry.
That's not a problem.